All right, welcome everyone. So, if you've ever stared at the stock market and just felt like it's this giant, impenetrable wall of numbers, flashing charts, and wildly confusing jargon, well, you're in the exact right place today. In this explainer, we're literally stripping away all of that complexity. We're going to break down the absolute basics of the stock market for absolute beginners, taking these massive, intimidating financial concepts and turning them into everyday, easy-to-grasp ideas. No confusing terminology, just a clear, structured learning path. So, let's just dive right in.
First off, I want you to picture something super simple, a 20 rupee Cadbury chocolate bar. Now, how on earth could this possibly explain multi-million-dollar corporate finance? Well, think about it like this. Imagine you have this chocolate bar and it's got 10 pieces. Let's say you really want 10 rupees to buy a toy, like a yo-yo. So what do? You open the wrapper and you offer your hungry friends one piece of chocolate for 2 rupees each. 5 of those friends buy a piece. Boom. You've just made your 10 rupees and you still have half the chocolate left for yourself. Believe it or not, this exact mechanism, it's the absolute foundation of the entire global stock market.
Here's our roadmap for today's explainer. First, shares and IPOs explained. Second, the stock market ecosystem. Third, types of equity trading. Fourth, 3 ways to earn. And finally, managing your risk.
Section 1. Shares and IPOs explained.
All right, so let's scale up that chocolate bar analogy to the actual corporate world. Imagine a real-world company that wants to aggressively expand its business. Let's say they want to open operations in South Africa, right? And for this, they're going to need a massive influx of funds, say 100 crore rupees. Now, realistically, a company usually isn't just going to casually walk into a bank and ask for a 100 crore loan. Instead, they do exactly what you did with the chocolate. They take their company, break it down into smaller pieces, and offer those pieces to the public in exchange for cash. And these individual pieces of the company's ownership, that's exactly what we call shares.
And honestly, this brilliantly illustrates our very first major concept. When a company issues these shares to the public for the very first time to raise that initial capital, it's called an IPO, or initial public offering. It's just like you opening that wrapper and offering the chocolate pieces to your friends for the very first time. It is literally the primary moment the company exchanges its equity for public funding.
But, what happens after the IPO? Well, let's jump back to your friends. One of your friends bought a piece of chocolate from you for 2 rupees. But let's say another friend in the group, we'll call him Saurabh, is incredibly hungry. He totally missed out on the first round. Your first friend is pretty clever, so he turns to Saurabh and says, "Hey, I'll sell you my piece, but it's going to cost you 5 rupees. Saurabh agrees and pays up. That transaction right there, hungry friends trading pieces among themselves at a premium, that is share trading. The company itself isn't involved anymore. This is purely buyers and sellers out in the public market, trading based entirely on supply and demand.
Now, what if the company actually successfully expands to South Africa? But then, a few years later, they decide, hey, we want to expand to Thailand now. They're going to need another massive round of funding, right? Well, they can actually issue shares to the public again. When they do this a second or third time, it's known as an FPO, or a fresh public offering.
Section 2. The stock market ecosystem.
Okay, so now that we actually understand what shares are, let's figure out exactly where and how they're traded. Think about it. If you want to sell $1 million property, you don't just go knocking on random doors down the street, right? No, you list it on a platform like 99 Acres or Magic Bricks. Well, the stock market works the exact same way. Companies list their shares on exchanges, and here in India, the major ones are the NSE, the National Stock Exchange, and the BSE, the Bombay Stock Exchange. But here's the catch. As a buyer, you can't just casually walk into the NSE and buy a share. Just like you'd need a real estate agent to set up a property viewing, you need a broker, think platforms like Zerodha, Upstocks, or Grow, to actually place your trades. And finally, when you buy that share, where does it physically go? I mean, back in the day, you got a physical paper certificate, but today, everything is digital. Your shares are safely locked away in a digital vault called a demat account. So to recap, exchange, broker, demat account. That is your entire ecosystem.
Section 3. Types of equity trading.
Moving right along, we're going to focus purely on the equity segment here, which just means simply buying and selling shares. Now, what's really fascinating about this breakdown is that the single defining factor between all these trading types is just one thing: time. First up, there's scalping. This is buying and selling within seconds or minutes just to catch tiny, fleeting price movements. Look, if you're a beginner, stay far, far away from this one. Next is intraday trading. This basically means buying and selling within a single trading day, between 9:15 a.m. and 3:30 p.m.
And listen, if you don't sell your shares by 3:30, the system will automatically close your position for you, whether you're sitting in a profit or a loss. Then we have swing trading. This one's a bit more relaxed. You buy a share and just hold it for a few days, a few weeks, or even a month, basically riding the upward swings of the market. And finally, positional trading, or what we usually just call investing. This is holding for months or years. This is that classic advice our parents always give us, like buying gold and holding on to it because you fundamentally believe the underlying value is going to grow over the next 5 to 10 years.
Section 4. 3 ways to earn.
All right, let's get to the part everyone actually loves. How exactly is money made in this ecosystem? Well, the absolutely crucial thing to know here is that there are 3 primary earning methods. First up is investment, putting your money into a fundamentally strong company and just letting it grow over the long term. Second is trading, actively buying low and selling high to capture those short-term price gaps. And the third method, which is honestly incredibly powerful, is dividends.
Let me break down dividends really quickly for you. Say a company is valued at 100 crore rupees, and at the end of the year after paying all their expenses, they make a fantastic 1 crore in pure profit. Now the company has a choice. They can either reinvest that money back into the business, or they can distribute it directly to the people who own the company, the shareholders. Because remember, when you hold a share, you are essentially a part owner of that business. So when the company shares its extra earnings with you, that lovely little cash payout is what we call a dividend.
Section 5. Managing your risk.
Of course, as we all know, where there's reward, there's always risk. And honestly, knowing how to protect your capital is arguably the most important skill you can ever learn here. When you use your broker to buy a share, you actually get to choose how you enter the market. A market order basically means you are buying immediately at whatever the current market price happens to be. Let's say 100 rupees and 5 pice. It executes in a split second. But what if you don't want to pay that? What if you want to wait until the price drops to exactly 105 rupees before making your move? Well, for that, you'd use a limit order. You set your desired price, and your broker automatically executes the trade, only when the share hits your specific predetermined target. It totally gives you control over your entry point.
Now, how do we actually limit our losses once we're in a trade? I love this next concept because it brilliantly illustrates it, the moldy bread analogy. Imagine you own a bakery or a bread shop. You've got hundreds of fresh packets of bread sitting right there on the shelves. But suddenly, you notice one single packet has fungus growing on it. What do? You definitely don't just wait around and hope it magically gets better, right? No. If you're smart, you throw that one moldy packet out immediately. Because if you don't, that fungus is going to spread and literally ruin your entire inventory.
Well, in the stock market, a bad trade is at moldy bread. And to protect your portfolio from it spreading, you use what's called a stop loss. Let's say you buy a share at 100 rupees, totally hoping it goes up to 110, but the market turns against you and the price starts dropping. To prevent a massive catastrophic loss, you set a stop loss at, say, 97 rupees. This basically tells your broker, hey, if the price drops to 97, automatically sell it for me. By doing this, you take a strictly capped loss of just 3 rupees, you throw out the moldy bread, and you save the rest of your trading capital so you can fight another day.
So look at what we've covered today. We've gone through IPOs, exchanges, trading timelines, ways to earn, and exactly how to protect your money. Now that you actually know the rules of the game and all that intimidating jargon has been stripped away, the real question is, are you ready to make your first move? I really hope this explainer gave you a super clear, foundational understanding of how the stock market actually works. If you found this structured visual approach helpful, please make sure to subscribe so you never miss our future explainers. Keep learning, keep analyzing, and I will see you in the next one.